All right, guys, welcome back. We are jumping into Module 6, which covers how to form equity partnerships and use equity partners to fund your fix and flip deals. This also applies to long-term transactions. So these are going to differ. This strategy is going to differ from your debt relationships that we talked about in the previous 3 modules. We're going to talk about how to structure an equity partnership and bring your money partner along for the ride. So buckle up. Here we go. Now, just like with every module that we do, we've got to share our disclosure. I'm not a licensed attorney, accountant, financial advisor, broker, agent, or any other licensed individual. I'm just a student, just like you guys. I've had a lot of success with the strategies I'm sharing with you, and I want to share that information with you because I like seeing other people go out and be successful. And who knows, maybe we can do some work together in the future. Now, let's talk about how equity partners differ from a debt relationship. So these are going to be the exact same people that we talked about in the previous module. People that that could potentially be private money lenders. In a debt relationship, this is going to be the exact same audience that you're looking at for an equity partner. Now let's talk about the difference between a debt lender and an equity partner. A debt lender earns a predetermined rate of return. The loan is secured by the property. They get paid first. So when you sell the property, the title company is going to pay off the debt lender first with interest and fees before they distribute any money to you as the property owner. It's not necessarily a profit sharing thing. Even if your profit is negative, they still get all the money you promised them. So that's one of the drawbacks of having a debt lender as your money partner on a deal. The agreement that you have with a debt lender is referred to as a note. A note is just, for some reason, a fancy way of saying loan. It refers to the document, the contract that's signed to outline the parameters of borrowing those funds. So they refer to that document as a note. With a debt lender, it's a higher risk for you and a lower risk for them. So let's talk about how an equity partner differs from that. An equity partner often provides up to 100% of the capital. There are no monthly payments because it's not debt. They are partners with you on this property. They usually want a higher ROI than a debt lender because they're taking on a little bit more risk, because they're either going to sink or swim with you as a partner. They're going to get a little bit more than they would being a debt lender. However, they take on a little bit more risk. It's a little more risky for them. They share in the profit, usually anywhere between 20 and 50%. They also will share in a loss, or they'll share in an alternate exit strategy. So if you have to turn your fix and flip into a rental property as an exit strategy, having an equity partner creates a great opportunity to be able to do that as an alternate strategy because they're going along with you for the ride. They understand the risks. They understand that, hey, instead of selling this thing and losing money, let's just turn it into a rental and make cash flow, wait for the market to turn around, and then we'll sell it when we can make a profit. The equity partner is secured by the property. They are your partner. So a lot of times you'll form an LLC or a joint venture agreement. You're going to want to talk to your attorney on a case-by-case basis to see what's going to be best for that particular situation, because there are pros and cons. And there are specific things where a joint venture is better versus an LLC and vice versa. The profit is distributed after all expenses are paid. So, the cost of the contractors and the materials and the cost of the home and the utilities and the taxes and all of that is paid first. And then whatever's left over, you're going to distribute between you and your equity partner based on the percentages that you agreed upon up front. They're along for the ride. Like I said, they're in for it, whether it's a profit or a loss or an alternate strategy. Obviously, profit is the desired outcome, but they're along for the ride no matter what. Now, they do have a say in the property. Because they're a partner, they legally have a right to have a say in the operational side of the property. So, you're going to want to have conversations with them as decisions are made as to what their preference is. So it does require a little bit of negotiation during the actual project and a little bit of back and forth. Like I said, the agreement is usually in the form of an LLC operating agreement or a joint venture agreement, which is what JVA stands for. As I mentioned, it's usually a little higher risk for the equity partner with the idea of a little higher reward. And usually it's a lower risk for you because you're not taking on debt that you absolutely have to pay back no matter what. They're kind of joining in and sharing some of that risk burden. So lower risk for you. Now let's talk about calculating your costs for an equity partner. On our example property of 123 Main Street, we had a purchase price of $250,000 and a rehab amount of $50,000. That means our total raise on that's going to be $300,000. So in the example of raising $300,000 in equity, there are no points because there is no loan. Points is a term that refers that's used in debt lending, not in equity partnerships. So there's no points. You can calculate your equity. So for example, if there's a $60,000 margin and you guys agree that you're 50-50 partners, 50% of that's $30,000. So that means they're going to make $30,000 and you make $30,000. That means that your cost of funds, based on the equity partnership, because you're splitting that margin 50-50 with your partner, your cost of funds are $30,000. That's what their share is going to be. So your $60,000 minus your $30,000 cost of funds, $30,000 projected net profit. But the nice thing is the break even is indefinite, meaning you're not going to have, time doesn't play a factor here. You're not going to have interest accruing and accruing as time goes on. So that margin's going to stay there, and that margin may be affected by things like overspending or mistakes that are made or the economy changing. But there is no point where your interest catches up with your margin. Because they're just in it and they're along for the ride. Now let's talk about the pros and cons of having an equity partner. Some of the pros are lower risk for you. So that means that they're going to come in and share that risk with you. There's no monthly payments. You have many more exit strategies by structuring an equity partnership versus a lending agreement or a debt relationship. So there's less stress over carrying costs. Your interest is not ticking away every day, right? When structured correctly, a lot of times these equity partners will reinvest with you on the next deal, right? So they'll become partners with you on your very next deal. Some of the cons are your cost is going to be a little bit higher, which means a little less profit for you. But I like that because this is a business of scale. If we can lower the risk on these properties, that's probably a good idea. Granted, it's going to cost you a little bit more, but you know what? If you want to make more money, just go out and do more deals. This becomes very, very easy, and there is no limit when you learn how to successfully use other people's money and leverage other people's time and resources to go invest in real estate. One of the cons is you do have a little bit less control, and it may strain the relationship if you have to use an alternate exit strategy. I usually try to prevent this by making sure that I'm completely transparent about all the things that could happen. I'm very clear on the idea that, hey, you know what? If this doesn't sell or if anything happens, we may be turning this into a rental, and we might just have to enjoy collecting, some cash flow for a while until we can turn around and sell it for a profit. So it may strain the relationship a little bit, but I think if you do your due diligence and making sure that you're transparent with your equity partner up front, it could minimize a lot of that risk. So that covers what we've talked about with equity partner. Like I said, a lot of the stuff that you need to know about raising money with an equity partner is going to be applicable to the same things we talked about in having a private money lender. It's the same audience and the same rules apply. You can't raise money from people you don't know. That's illegal. It has to be people you've had a pre-existing relationship with, and then if you want to go partner on a deal, go do it. So that brings us to the end of Module 6. We're going to now talk about how we combine those two to create an optimum fix and flip funding strategy. In our next module, in Module 7, we're going to be talking about the debt equity blend. It's really the best way, in my opinion, to stay safe and to make that money that you've raised go the furthest so that you can scale to the moon with this thing. So stay tuned for Module 7 because we've got a lot of good stuff coming up. We'll see you there.